For the past many months, I have seen many articles asking the question, is value investing really dead? So is it true that value investing is really dead? Before we answer this question, is value investing really dead? It's important for all of us to understand what value investing really is. Many of you are probably familiar with the term value investing and see Warren Buffett as the poster boy for it. But did you know that value investing started out very differently from Buffett's famous investments such as See's Candies, Coca-Cola, and the recent Apple purchase? To know how value investing evolved, we have to know who is Benjamin Graham, or is known as the father of value investing. When Graham first penned down his thoughts about investing in his book Security Analysis, the term value investing wasn't even coined yet. But to Graham, he already had his own distinct ideas on how to differentiate a company's stock price and its intrinsic value. Security Analysis first edition was published in 1934, and America has just gone through one of the most severe economic recessions in the 20th century, called the Great Depression of 1929. The stock market collapsed as well, and there were many public listed companies that were worth more dead than alive. In other words, those companies were selling for less than their liquidation values. Graham's analysis was very much on the balance sheet, a document that tracks what those companies own and owe. In fact, Graham ran his own very successful hedge fund, the Graham-Newman Corporation, which had annual returns of around 20% from 1936 to 1956, using a technique which relied extensively on the balance sheet analysis. This technique was called net, and it can actually be expressed in a simple formula which looks something like net equals to current assets minus total liabilities. Graham wanted to find stocks that were selling at 2/3 of its net value because he wanted a margin of safety. He knew that stocks selling at such depressed valuations were often in trouble in some way or another, and so wanted to use a very low buying price as a buffer in case things did not work out. To increase his odds of success, Graham also diversified widely, with some accounts saying that he had more than 100 stocks in his portfolio at any one time. By diversification, he allowed the natural laws of statistics to play out with the stocks in his portfolio. Surely, such cheap stocks will rebound in price as people realize the folly of leaving a company worth more dead than alive, especially when they had minimal debt loads and were still making profits. Graham's investing style could not more aptly named than cigar butt investing. Buffett coined the term when he described Graham's investing methods as finding a used cigar butt lying on the ground that was still good for one final puff. It did not cost a cent, and you could still enjoy one enjoyable puff. Perhaps Graham's greatest legacy was leaving the world with the concept of a margin of safety, which means making sure your purchase price is low enough to mitigate any potential mistakes in evaluating a business intrinsic value. And Mr. Market. Mr. Market is an allegory for the stock market, as Graham likened the stock market to an individual suffering from bipolar disorder. The stock market can be extremely euphoric at times, resulting in overpriced stocks, which gives you an opportunity to sell, and then swing to a despair, resulting in severely underpriced stocks, which gives you an opportunity to buy. As Graham's student in Columbia Business School, those were the greatest lessons Buffett learned from his teacher. But how did Buffett end up investing in businesses that could grow their profits surely over the years? In the early days, Graham taught the investing course at Columbia Business School, which Warren Buffett had attended. After Buffett's graduation from Columbia Business School, he eventually ended up working for Graham at his new investment firm, which is called the Graham-Newman Corporation, GNC for short. People familiar with the term value investing in modern times might associate with Warren Buffett and the analysis of a business ability to generate above average and sustainable profit margins and cash flows. Buffett wants to find compounders, or rather companies that can grow intrinsic value over time. Sometimes such method of investing is also known as growth investing today, which is in fact a modern type of value investing. So is value investing really dead? Not really. In my next video, I will share another super value investor who had generated returns of 20% per year for the last 47 years. Please help to click like and subscribe to our VIA channel to learn more about value investing. See you soon.